Hey guys, today we're gonna go ahead and lay out the income statement. So I'm gonna go by line item and explain what does each item mean. Total revenues is basically the revenues that a company gets at the end of the year or a quarter, depending on what report you're looking at. This is the amount of money that the company earns from selling all of their products, uh, regardless of their expenses and everything like that. So you're going to find total revenues on the income statement, obviously. So let's look at the income statement. Okay, this is my 10K. Just zoom out. Okay, and we're just gonna, and you're just gonna go through it until you find your income statement, which is over here. Typically, income statements are about a page and a half long. As you can see here, this is a little shorter than a regular income statement. Regardless, this is an income statement. So we're gonna look at the 2006 column. As you can see, the net sales, it says net sales, but total revenues and net sales are practically the same thing. So it's gonna be 12,237.7. 12,237. 12,237. 12,237. Let me see if I copied it right. Okay. So our cost of goods sold, that will be followed right after our income statement, which is also called cost of sales. Now, what cost of sales are basically all the expenses are related with the selling of the good. For example, if you're selling your products, the overhead and the materials, the raw materials and everything like that is going to be counted into the cost of goods sold. Now, the cost of goods sold is also a good place to hide non-recurring items, so we're going to look into that later on in the workshops. That's why we have a reported and pro forma. We're going to take a normalized cost of goods sold later on in the workshops and lay it out over here, but we're not going to worry about the pro forma lines right now. Okay, SG&A and other, basically SG&A, selling, general and administrative expenses, deal with the basically expenses for expenses that's dealing with advertising, also paying out your executives and their bonuses and whatnot. 43,552. That's what's counted into the SG&A, and along with other income, other expenses and income are basically income and expenses still contributed to the operations of the company, but are not considered cost of goods sold or SG&A. For example, you can have other losses, essentially by the warranties. Let's just say there was a big callback of all huge amount of products that were not working, so you're gonna call them back and you incur a loss. Therefore, that will be considered as other loss on the income statement. So pro forma, we're gonna worry about that later. How do we find our EBIT? Our EBIT is basically our total revenues minus our COGS and minus our SG&A and other. That gives us our operating profit. Operating profit, or EBIT, earnings before interest and taxes, comes into a big role when we're comparing this company to another company, or when we're trying to find EBITDA. So please keep in mind that total revenues minus COGS of goods sold, SG&A, and other operating income or expenses is going to give you the operating profit, also called EBIT. So how do we get interest expense? Well, we're going to look back at our income statement. Our interest expense is basically the expense accrued from our loans, the interest payments that we have to pay. In this case is 158.7. Okay, our non-operating income or loss, as we can look on our statement, we do not have any non-operating income or loss. Therefore, actually, I'm sorry, I think I messed up over here. On SG&A, I forgot to add other expenses. So make sure you do add other expenses. This is just a shortcut for me to add another number But as we can see here, we did find SG&A, but we forgot to put in our other income and expense, since we were doing SG&A and other. You'll see in some models that you'll see SG&A and other separated, but majority of the models have SG&A and other lumped in together for simplicity. So we're 185.9. So we're going to add 185.9, and you can see we have 4541.1. Okay, so back to non-operating income and loss. What exactly is non-operating income or loss? Basically, it's income or loss not attributed to the operations of the company. For example, you can take cash that you have from your watch company, and you can take that cash and put it into the stock market. Now, whatever gains or loss you have in the stock market would be counted as non-operating income or loss. Reason being that it is not the core operations of the business. That's what it's called, non-operating income or loss. Okay, so where do we find that? As we notice that we don't have it on the income statement, usually when there's no line item like that, that means that that income is did not occur. So we'll have 0. So pre-tax is basically our operating profit subtracted our interest expenses and added our non-operating income. Okay, and we get 2001.8. Okay, so taxes reported, and taxes essentially, as the title shows, as this is the taxes that a corporation has to pay. In this sense, it is provisions for income taxes, which is 648.4. 648. Sorry, 648.4. Okay, and equity and income affiliates after tax. Equity and income affiliates are basically, let me give you an example. Let's just say you own a watch company, and you decide to have 20% ownership of another company. Let's say Walmart. You are going to write your investment in Walmart as equity and income of affiliates. Typically, the rule is if you have more than 20 to 25% of equity into another company, you essentially have to report that as equity and income of affiliates. So therefore, you earn dividends, maybe, or even interest payments towards you, and you're going to count that as income from equity ownership. As for minority expense, interest expense is basically the opposite of equity and income. Essentially, you have Walmart that has 20 or more percentage ownership into your company. Therefore, anything that any special payments that you're going to pay out to them is going to be called minority interest expense. Okay, so where do we pull out these numbers? Well, as you notice that we don't have it on our income statement. Typically, in this case, they have actually lumped this up with, I think, SG&A or COGS, one or the other. So how did we find that out? Well, we found that out by reading, and usually takes about a week or two to kind of read through these type of material. But for easy use, we know where they are, and they have actually kind of pointed it out earlier in the income statement where exactly is our minority expense, I believe. Let's see. Yeah, there. On page, let me go down. Oh, sorry. On page 13, we have our minority interest in our equity income. Okay. Now you'll notice that in equity they have parentheses, income, close parentheses, which means that whatever is in parentheses is actually income, and whatever is opposite is going to be loss. Now, why do we pay attention to that? Well, we pay attention to that because we're recognizing it in a different way. As you can see, equity and income enter as positive. We're going to not put the parentheses. Okay, so let's see. Okay, so we have equity and income in 06, 3.4. So we're just going to put positive 3.4. And as for minority interest expense, we're going to put, like, you will notice that we're doing the opposite again. In this case, we're putting it as a negative, as you can see. But on the 10K, they're actually doing it opposite. They're comparing it oppositely. So in this case, is not a parenthesis. So please do read your line items carefully and see when are you supposed to put the parentheses and when you're not supposed to put parentheses around it. So 57.5. Okay, and our net income is basically our pre-tax income subtracted our taxes reported, and add our equity and income, and add our minority interest expense. Okay, hold up, I forgot to put a negative over here. Now, why am I adding minority interest expense? Well, if you look at it, it is already a negative. So if we actually put minus F35, that makes it into a positive, and instead of subtracting out the minority interest expense, we're adding that in. So we have to make sure that we are not doing that. That's why we are adding this particular line rather than subtracting. Okay, so our common dividends, where do we get that number? Well, we get that from our 10K. We are going to get that from the statement of retained earnings. So as we zoom out over here, we're going to find this is our balance sheet, this is our retained earnings, and we're going to have 06. Okay, 06 dividends declared. We're going to add our Series B preferred stock dividends and our common stock dividends. In this case, this is 28.7 and 649.1. So let's put 28.7 plus 649.1. Okay. Why do we do that? Well, the reason we do that is because sometimes there's two different meanings of common dividends. It can mean preferred dividends and common dividends combined, or it can also mean just common dividends alone. So we have to be very careful what exactly we're looking for. In this sense, we are looking for the common dividends because this is going to come in use when we're trying to find earnings per share and whatnot. Okay, we're gonna stop the video over here. I'm gonna start talking about EBITDA, EPS, and diluted EPS in the next video. Bye.